Hey, this is Mary with QuickWin Bookkeeping. This is video 2 of our series on Let's Talk About Financial Reports. I know, an exciting topic, but it's actually very important, especially for running your business. So let's just go ahead and dive in. Today we're talking about the statement of cash flow. So what does the statement of cash flow tell you? This report is often overlooked or completely ignored. I've even seen CPAs send out their financial reports and not include it. But this statement has vital information for you for your business, in particular for your cash. So I'm going to start off with a scenario. Let's say that you're going camping. You pack up your food, you pack up your supplies, you pack up all the things that you need, including water, drinks, etc., right? And you go out on your trip, everything's going well. Say you're going for several days, right? And you've packed up what you felt was going to be appropriate. Now it's a few days in, everything's been going great, you're having a great time, and you come off of a hike and realize you only have enough water to get you through maybe that night, but you don't even leave until late the next day. Now you're running low on water. You don't want that scenario, right? Well, that's the same thing with your cash in your business. You don't want to just be settling like, oh shoot, I'm almost out. You want to be monitoring it. And that's actually what the cash flow statement helps you do. It helps you keep an eye on that. And if you're monitoring it from month to month, you're going to see when you're running into trouble, and hopefully you're not running into it often. If you're finding that your cash flow is tight some months and other months it's not, and it's back and forth, that's still not good. But that's why you want to monitor it, because if you're having a problem with your cash flow, then it means that you're needing to make some adjustments in your business so that you can be in a better position. You always want your cash flow in a good, positive position. The thing with the cash flow statement, it also lets you know if you're cutting into your profits too much. Even though you might be doing great with your profits, your cash flow might still be struggling. And if that's happening, then something that's not part of your profit and loss is affecting your cash, and you need to take a look at it. So now that you understand why this is an important statement to keep an eye on, how do you read it? There's 3 primary areas of activity that this report covers. The first area of activity is your operations activities. This is a key piece all by itself, because this is telling you whether or not your operations are being covered by the cash that you're bringing in. So if the profits themselves are helping you sustain the operations of the business, that is a key factor all by itself. We'll dig it more into it later, but for now, just understand that that is by itself. Think about it. If your profits are not covering all of the operations of the business, not just expenses, but everything else that may be included, then obviously you need to take a look at that. So you're going to notice that the cash flow statement actually pulls in some of the main accounts that you'll see. Obviously your net income, but also items that you'll see on your balance sheet, but it's showing how those accounts are affecting the cash. There are 2 methods that can be used for determining cash flow. One is a direct method, and the other one is an indirect method. For the purposes of this video, and if you use QuickBooks Online, indirect is the method that is used, and that's what we're going to cover. So your operating activities, those are going to include obviously your net profit or loss. Then it's going to do adjustments to reconcile the net income to the actual net cash that are provided by the operations. This includes your AR, your AP, credit cards, and stuff like payroll liabilities. It's really anything that is directly related to the operations of the business. Now these can either increase or decrease the cash in the business. Let's use AR as an example. Let's say that you invoiced $300,000 during the month, but you only got paid $100,000 during that month. Well, that's obviously going to be a negative effect to the cash, because you didn't receive as much as what had to go to AR. In other words, AR is what's left and still waiting to be paid. So you didn't get all that cash. So that's going to have a negative effect to the net income because it's going to reduce it down by what you did not receive. Similarly, with accounts payable, say you've got $100,000 worth of vendor invoices during the month, but you only paid out, let's say $70,000 of that during that month. Well, obviously there's a difference that needs to be reconciled towards that cash. The actual cash that was paid out needs to be accounted for. That should bring you to the line that's called the total adjustments to net income to net cash provided by operations. That number, you really want it to be a positive, not a negative. That's not to say that you can have a month that isn't negative, but you don't want that happening on a consistent basis, which is why you want to monitor it. And obviously, the more months that you have that are positive, the better. If you start having ups and downs, you need to take a look and see what's going on and make adjustments that will fix this. And the reason this number will be positive is means that you're generating enough cash to cover all of the operations of the business. That's a good thing, always a good thing. Even if it's minor, it's still good. Obviously, the higher, the better. Now let's take a look at the investing activities. Simply put, the financing activities include if you purchase fixed assets. Think about when you purchase equipment, vehicles, property, things of that nature. When you're purchasing those investments, you are depleting the cash. So you obviously want to make sure you're doing it at a right time if you're using cash directly. It's not a bad thing to use this for investing because if you were ever looking at potential investors in your company or wanting to sell your company, the purchase of those assets show that you were investing in the future of the operations of that business. Nevertheless, that is going to have a negative impact for the cash. So just make sure that you're not cutting too far, and I recommend not doing it at a time when your cash flow is clearly low. On the positive side, if you're selling any assets, you're selling equipment, you're selling property, then that's obviously going to have a positive impact on the cash because you've sold it. You brought in cash into the company. Now, if during the period you have no financial activity, which will probably happen pretty often with small businesses, it will simply not show up on the report. So if you don't see it there, that's why. Now to the financing activity. This section is focusing on cash that is used for financing the business. This includes like if you get a business loan to put cash into your business, or the owner invests money, puts money into the business, or a shareholder or something like that. Anytime money's coming into the business that's coming from either a loan or from an owner or shareholder, that's going to be a financial activity into the business, so that's money coming in. Same is true for the money going out of the business if you're paying off a loan or you're paying distributions or owner's draw. Those all are funds going out of the business. Those never show up on the profit and loss. So you still have to account for those as well. So that's what this statement helps you see. You are able to see what effect those have on your cash. On a typical basis, you're more than likely going to see that as a negative effect, but as long as that negative effect is smaller than the effect of the operating, then you're probably good. Again, the key here is you're wanting to make sure that from month to month to month, you're seeing the cash flow increase, or at least if you're at a good place, at least keep fairly steady. You don't want that constantly dipping and going in. A single month of net cash increase being a negative is not necessarily a bad sign, but if it consistently happens or it's up and down, then you do have a cash flow issue that needs to be addressed. So that's the basics of the statement of cash flow. I hope you found this information beneficial and helpful. If you like these videos and you want to continue seeing more, be sure and click subscribe, and we'll see you in the next one.